A tax plan to beat the tax man even when you're gone. Making sure your family doesn't have to pay unnecessary taxes. I'm Tracy Capelman. Join me right now for Your Wealth Health. Hello and welcome to Your Wealth Health, a show focused on helping you manage your money. I'm your host, Tracy Capelman, and I am here once again with the founder and CEO of Hilltop Wealth Solutions, Eric Brenner. Eric is a certified financial planner with nearly 30 years of experience. He's written financial articles for national media outlets such as Retirement Daily, and he serves on the board of several companies. Now, tonight, we're concluding our series of shows designed to help you develop a tax plan to beat the tax man in retirement. Today, the important issue of estate planning and managing long-term healthcare needs. Eric, we hate to think about getting old and eventually leaving this world, but it happens to everybody, and we need to have a plan so our family members don't get stuck with bills and, well, they get to enjoy what we wanted to leave them, right?
Yeah, it really is true, Tracy. For the new clients that we see, typically 50% of our new clients do not have an estate plan. And that really leaves the family that's left with some challenges often. And so, it's really important to organize what you have worked hard for and make sure that it gets passed in the most efficient manner.
And Eric, figuring out a so-called step up in basis strategy is just really critical in this process.
Yeah, it is. And, Tracy, stepped up basis right now in the current tax law still exists. And it's a big tax advantage when someone passes away. And basically what stepped up basis means is that when someone passes away, your beneficiary that inherits your asset gets a stepped up in what they paid for it. So an example would be if they bought a stock for $10,000 and it's now worth $100,000, and they sell it as the owner, they have a $90,000 capital gain. But if they pass away, then their beneficiary gets that price or what they paid for that stock at $100,000. They could sell it the next day and pay no taxes. And so I've put together I'd like to take a look at the graphics and take someone through an example here, Tracy, on just how sometimes things can get overlooked. And so this example of Phil and Mary, you can see they have a taxable investment joint account that is owned joint tenants with rights of survivorship. There's $120,000 of investments, and it has long-term capital gain. And unfortunately, Phil's diagnosed with a terminal illness and just, has a very short period of time to live. Now, what they could do, as you see on the next graphic, is if Phil dies and Mary inherits Phil's half of the joint account, the stepped up basis eliminates the long-term capital gain on Phil's $60,000. So you remember, Mary still owns part of this account, so she still has her long-term capital gain. So if she sold all the investments, she only owe income tax on her gains, and her gain equal long-term gains on her $60,000 plus any gain on the remainder. And the bottom line here is that Mary owes tax on the $60,000 plus any on the half after Phil's death. But if you look at the next screen, it would be, well, what if they transfer all of this while living to Phil, and then she inherits it all? She now inherits, Tracy, this entire account, $120,000, and pays zero in income taxes. So just by making that move, just shows that it's a pretty simple move, but often overlooked.
That's really significant. I think people, when they're going through a life-threatening illness, perhaps just, are so caught up in the battle that they don't realize the significance of what somebody could help them with, a professional. Now, Eric, let's talk about something else. What about people who don't use up their retirement accounts and they want to leave money to family? What do they need to do?
Yeah, so particularly, when you leave money, it really depends on what kind of money it is. And so we talk all the time, Tracy, about retirement, IRA retirement money, qualified money. And so new law says that when you leave money to a non-spouse beneficiary, for the most part, they will need to draw this money out within a 10-year period. And so I have a graphic here that shows an example of Pam, who's 65 years old, has a son, Kyle, 40 years old. Pam dies and leaves 100% of the IRA to the son. And with an IRA balance currently of 400,000, and if they just average 6% return, you can see that he can take his distributions over 10 years. So he has to do that within the 10 years, whether that's all in 1 year or whether that's spread out over 10 years. And you can see that $400,000 IRA balance now is equal to $54,000 a year if he takes it out over 10 years. The other option he has is he has that option of he does nothing, and in the 10th year he takes it out. So now you can see that with this $400,000 original balance, 6% average return, he now has $716,000 at year 10. But the key here, Tracy, is that you have to take the money out by the end of the 10th year. And so what we're now seeing with this change in law that happened a little over a year ago, we're seeing where people now have to make more decisions as to when to actually distribute the money from their IRAs. It's going to be really important from a tax perspective as to when they choose to take out the inherited money.
Absolutely. That makes a big difference. Now, we mentioned this at the top of the show, and again, another uncomfortable topic to discuss, but people really should plan for the possibility that they might need long-term care. I mean, people are living longer and longer.
Yeah, they are. And so, long-term care is and can be an issue, and it can be a major expense. And I'm sure most of our viewers know somebody, a loved one, a family member, a friend that has been affected by it. And it can be really costly. So kind of the way we think about it is we think about people fall into one of three groups of folks. The first group of folks is if they need long-term care and they have to pay for it. And Tracy, that can be upwards of $60,000, $70,000, $80,000 a year. They have enough assets they could pay for it. It really wouldn't hurt them. The other group of folks are they don't have a lot of assets, so if they need care, then they would pay for it and eventually qualify for Medicaid. And then you've got this kind of in-between group where it would truly affect them and affect their situation, not just financially, but emotionally. And Tracy, the statistics are that if a couple of 65 years old today, the chance of one of them needing at least some form of care is greater than 50%. And, that doesn't necessarily mean in a facility. That doesn't, that could mean at home care, but people are living longer. We talk about this a lot on the show. We're seeing longevity and people living longer, which is a great thing. People are enjoying retirement a lot longer than what they did 25 years ago. What that also means is potentially they could have these costs that would come up that would be very expensive for them to cover.
Absolutely. They just need to plan ahead. Well, Eric, we've discussed so many issues related to tax strategy in retirement over the past 4 weeks, and we want to help people out with this by offering a free retirement tax analysis. Can you tell our viewers a little bit about that?
Yeah, sure. So, what we do with the tax analysis is really expand that to what we call a retirement roadmap review. And so what we do there, Tracy, is really at no cost, no obligation. If somebody really wants to know, are they on the right road? Do they have a good strategy in place? We'll take a look at their retirement income planning strategy. We're going to take a look at the risk that they're taking. Are they taking the right amount of risk? Are they taking too much risk? Are they taking too little risk? we're going to have a forward-looking tax plan. So we're going to look ahead and determine, what is going to be best for them from a tax perspective. And then finally, legacy planning. We talked about estate planning and how important that is. So we're going to put together that overall retirement roadmap review, and then really they can determine, are they on track? And then, we can also help determine if we can actually benefit them and help them.
And Eric, what's the age range? I mean, when should somebody start? Is it ever too early, or is there a time or an age when you think it's really critical they do this with you?
Yeah, so I think that really any age as far as planning is good. So the way we think about it is kind of climbing the mountain and coming down the mountain. As you're climbing the mountain, people are saving money. They're saving for retirement, putting kids through college, paying off the mortgage and so forth. That's climbing the mountain. On the way down is the descent. That's where they start thinking about, or they're in retirement. So really planning stages is all throughout, to kind of plan for retirement along the way. But this retirement roadmap review is really good for those that are 5 years or less from retirement, or if they're in retirement. I sit down with a lot of folks that are already retired, and we're able to really take a look at their situation, and they may not be taking advantage of everything that they could be.
Absolutely. Well, we hope people will take advantage of that. That's just such a good resource. We have run out of time for this edition of Your Wealth Health. For Eric and the entire Hilltop staff, I'm Tracy Capelman. Thank you so much for watching. We'll see you next week. And until then, stay wealthy, everyone. We hope you found this discussion helpful today. Don't forget to like and subscribe to our channel for new content weekly.